Hey everyone, in this video I'm going to be going over Jamieson Wellness, which is a Canadian dividend growth stock that I've been buying over the last few months here. In this video we're going to do a bit of a stock overview of how their stock has been performing and some of the key metrics before doing a business overview and then jumping into what this company is doing for growth in the next few years and what they've been acquiring, and ultimately why I think this is a great dividend growth stock to buy, in my opinion, and why I've been adding it in my portfolio. So we're just going to jump right into this one. Looking at the stock here, you can see here the stock's now down over the last 5 years slightly by about 1%, which is really just driven by the last couple periods here. You see year to date, the stock's down a whopping 35% to under $1 billion in market value here, currently at $957 million. And they're paying a dividend yield of about 3.4% here as well. So not only is this company a really strong dividend grow over the last number of years, but they've also built into a pretty nice starting yield as well. And we'll go through that at the end of the video. But in terms of just ranges here, the stock was up in the mid 30s at the beginning of the year. As we look at the stock over a bit of a longer term period, you can see it was growing really nicely and organically from the high teens all the way to around 30. And then the pandemic happened, lower interest rates, higher demand for these types of health and wellness products. Stock went all the way up to 43, and it kind of stabilized in the 30s before trending down really aggressively throughout the year this year, which was really interesting. The multiple has just gotten crushed. Their earnings per share has actually been going up. So I really want to go into that and just talk about how I think this stock is a pretty good value at these levels. But before that, I'm going to just do a bit of a quick business overview on Jamieson. Some of the brands that they own, obviously their namesake brand, Jamieson, across lots of vitamins and other categories. So you can see them selling vitamin C, all these different types of vitamins for different things, probiotics, prebiotics. They're a huge vitamin player in Canada, but also growing around the world as well. They also own a number of other brands pertaining to iron. You see Iron Vegan there, Progressive Smart Solution, etc. So these are lots of protein-based brands that they own as well, that they distribute across Canada. And recently, which we'll talk a bit later in the video about, they recently acquired Theory, which is an American VMS brand as well that sells vitamins, minerals in the US market, which is a very premium brand there. In terms of just organic tailwinds other than business operations being expanded, they see a lot of opportunity, and I agree, on health becoming a category that lots of consumers begin to spend more time focusing on. Health and wellness in general, as there's more disposable income in developing markets and in developed markets around the world. More people are going to be trying to improve their health, live longer, live better lives. In addition to that, we have aging populations that really need these types of products, and these products were not previously available to lots of other aging demographics in prior generations. Expanding access to information, people can easily learn about the benefits of taking a supplement or more vitamin C, vitamin D, whatever it is they need, which directly kind of points to some of the increased usage of the products that Jamieson sells. And then we kind of touched on self-care as well. Just going into their long-term business overview. And this company has been around for about 100 years. It's really ramped up over the last 20, 30 years as they've gone public, raised more money, expanded. But this is a big, or an old company. So I really like that they kind of show the 30-year trend here. And you can kind of just get a sense that over time, they've driven a lot of revenue growth pretty organically. Sure, they may have dips here and there, but generally, they've gone from 100 million in the early 2000s to about 200 million 10 years later, and now we're all the way at 400 million in 2020, going to be 700 million in the next year or so, and that has been a revenue growth rate of over 12% since they IPO'd in 2017, and they're seeing growth rates on earnings per share up at similar levels as well. So the business has grown really nicely, double-digit growth over the medium term. And as we start going through some of these numbers, keep them in the back of your head as we talk about the valuation later on, to make you put a value of what you think this company should be trading at from a price to earnings multiple and whatnot. In addition to the revenue growth there, you're seeing that really trend down into their business really nicely here. Gross margins have been going up every single year over the last 5 years. Now, this is a bit masked, let's say, because this last year they had the U-Theory acquisition. So obviously on absolute gross margin dollars, they're going to be up. I think it was about $21 million. And you see that they had a bit of a margin hit as they had to kind of incorporate U-Theory, one-time costs, and also U-Theory as an organization had lower margins just because they were a smaller business and didn't have the same level of scale. But I think that should smoothen out over time, and they should be able to get back up to this 22-23% gross margin level in no time here as we go into 24 and 25. But it's great to see them really focused on delivering absolute gross margin growth. And even on a per share basis, we're seeing that come through really nicely from 85 cents to $1.70 this year. So they've essentially doubled their EPS since 2018. So that's pretty good performance for a company that's in a category that's still planning on growing. They doubled their EPS in the last 5 years. They have a CAGR in the double digits. So everything I've seen so far is pretty strong. In terms of how they organize their business, they really do have 4 divisions, and I'd say they really focus on 3. So Canada's kind of like their cash cow because it has their big Jamieson business, founded in Canada, has really broad distribution. If you go to any retailer in Canada, you'll see a whole wall of Jamieson products and all the SKUs that they hold. US is a huge opportunity, in my opinion, the biggest opportunity for the company because they don't currently have the Jamieson brand in this market. And in addition to that, U-Theory is still mostly on the West Coast. So there's opportunities to expand U-Theory nationally. There's opportunities to cross-sell current customers that take U-Theory with Jamieson and other protein-based brands that they own in Canada. So I think the US is just a huge market, biggest economy in the world. Huge opportunity for them right now where they barely play. China is a big opportunity as well, and they've made a recent investment there that we're going to talk about. And lastly, international, they just export to wholesalers in other countries, mostly in Europe and Asia. And I'd say that's probably, while it's the 4th pillar, it's probably the lowest priority out of the 4 kind of profit centers as they view them. And you can kind of see that based off of where they're focusing, where they're investing, where they're acquiring as well, which we'll get to in a second. So this just kind of goes through their history in these 4 markets. You can see the US here, $40 billion plus vitamin, mineral, and supplements market, has a really nice growth rate too. They did not operate in this business until last year when they acquired U-Theory for half the year. So you can see out of the 600 to 700 million of revenue, about 20% of it, give or take, is coming from the US behind the U-Theory acquisition. So a decent chunk going into China here, while a much smaller chunk, closer to 50 million, so 7 or 8% of total revenue for this year. Really nice growth year over year. I think the jump from 22 to 23 was really driven by them buying out their wholesaler in the country. So they actually own their Chinese business, which is actually pretty rare for lots of smaller CPG companies like this. So I have a slide on that we'll get through, but the growth rate has been exponential for the category overall in China, and obviously tons of consumers there, so big long-term opportunity in China. And then Canada here, you can see half the revenue is coming from Canada. Really developed business though, so the growth isn't there to the same extent. That's why they really do treat Canada almost like a cash cow, bringing in tons of operating income to invest in growth in those other markets. And then lastly, the 4th priority is international. So you can kind of get a sense here. Strong distributor partnerships in 50 countries. So they don't own the distribution. They're just selling products to distributors in Europe, Middle East, South Asia. And the revenue has been a lot more all over the place. just seems like not really something they're overly focused on pushing and growing as much as they are in China or the US, or even taking care of the business in Canada. It's just kind of nice to have those sales and get that global exposure. But they definitely talk about this like it's their least favorite child out of the four. So that's just something to keep in mind. I do want to talk about the U-Theory acquisition because I think it's a really good part of the growth story. Organically, they've been growing revenue and EPS double digits, but now they're really looking at how can we drive scale and how can we accelerate growth on revenue to get that synergy and get that leverage on our platform and our manufacturing plants. And that's where some of the moves that they've recently made come into play. So U-Theory is probably the more strategic one. They brought in another brand. This is a really high-end brand they brought in. They have a couple huge powerhouse SKUs. Turmeric here, probably saying that wrong, I'm being told is one of their best SKUs that they're really known for in the West, so really big in California. As we look at U-Theory a bit deeper, over $100 million of revenue, 19% EBITDA margin, so lower gross margins than the Jamieson company had prior. But you can kind of see number 2 ashwagandha SKU in the US, number 1 fastest collagen SKU in the US, number 1 branded turmeric SKU in the US. So they have some really big powerhouse SKUs. And even when you look at them on Amazon, huge amount of reviews, 3,000 reviews on the ashwagandha SKU and whatnot. They have tons of SKUs here, just as you continue to scroll down, different forms in terms of pills versus other application methods with liquids, joint pain, joint complex for men, for women. I can just keep going here, magnesium powder, beauty power, etc. So they're in a bunch of different product lines to do across vitamins, mineral supplements. And it seems like e-com is a huge business for them, especially given kind of the price of some of these products in US dollars here. In terms of the rationale and how this is going to drive shareholder value, how this is going to help them grow in years to come, they really lay out a great case here for why they did it. They can see over 20% rates of return. They really wanted to get exposure into the US VMS market, which they've successfully done. They think it's a strong tie-in and complementary to the existing business they have. They now have US manufacturing capability and a diverse channel mix, which is great when we're talking about maybe producing Jamieson in the US in the future and selling that to US retailers. They also got a lot of know-how from the US market, and they can obviously achieve some synergies on the back end and in their processes as well. So lots of pros in taking this brand in-house and just enabling them to drive revenue growth, not only organically, but also through the acquisition. The other one here that they recently did, which is another kind of pillar of growth for them, is in China, which is a big focus for the company aside from the US. They announced a distributor acquisition, so now they own their entire logistics and value chain end-to-end in the Chinese marketplace. This was a deal that they had an option to do for the last number of years, and through listening to lots of the conference calls, they were always really excited to get it done. So now they're working directly with their Chinese division and responsible for consumer insights and whatnot in China. So a lot more in their hands now, but they are going to be able to make that unit a lot more profitable for the company. It's a lot less of a distributor relationship where they're leaving profit on the end for the distributor, the local distributor, to take for their business. And now they're getting all of that margin since they own the end-to-end chain, just like they do in Canada and the US. So this is a big strategic market for them, only $50 million of revenue right now, but growing super quick. So this is a great business to own end to end. Obviously, having a big business in China, which I wouldn't say they're big in China yet, it's about 7-8% of their revenue, has some levels of risk geopolitically, but overall, it's still not to the point that China's dominating the story. It's just another growth lever other than the organic tailwinds, other than what they're doing in the US with U-Theory and soon to be Jamieson. So lots going on for this company in terms of growth benefits, whether it's China, whether it's the US, whether it's organic consumer growth of these types of products. And as I look at kind of what they've achieved on dividend growth, just in 2019, they were doing 9 cents a share. You can see every single year they've increased it. So 9 cents to 11 cents, that's a 20% gain. 11% to 13 cents, that's almost another 20% gain. 13 cents to 15 cents, it's a 15% gain there. 15 to 17, 12, 13%. And then even with the stock price down huge this year, they still increased their dividend another 2 cents, which is just over a 10% gain this year. So double-digit dividend growth. They've gone from 9 cents 4.5 years ago, to 19 cents today. So they've increased their dividend by over 100% in 4 years. So looking at this stock here, and we'll go to the earnings per share in a minute, but you're looking at a company in the last year here that's down 32%, despite the fact that they've been growing their revenues year over year, double digits, growing their EPS double digits, doubled their EPS in the last 5 years from that chart we saw at the beginning, has more than doubled their dividend in the last 5 years. And that's not one of those optical dividend increases like you see on some of these smaller dividend yielding stocks like Alimentation Couche-Tard, doubling their dividend and they're still under 1%. They've doubled their dividend and they currently have a yield of over 3%. So they actually have a strong starting dividend with an amazing track record, both on dividend growth and just EPS and revenue growth. They just made a bunch of investments behind the acquisition in the US, the acquisition of their distributor in China, that should have them growing revenues and profits into the future with limited share dilution, yet the stock is down 32%. When we look at their EPS estimate for next year, it's $1.86. $1.86 next year, $1.60 this year. So going to their stock, at $1.60 this year, the stock's trading at about 14 times earnings here, 14 to 15 times. And then next year at $1.86, the company's trading at 12 and a half times earnings. We can look at other CPG companies here. If I was to go to a company like PepsiCo, for instance, and PepsiCo's trading at a 27 times earnings for an industry that I would argue does not have the same level of secular tailwinds as Jamieson has. In addition to that, they do not have the same level of room for growth just because their absolute size is 250 times larger. So I just think the opportunities, especially for a Canadian investor, being able to invest in this stock in local currency and not having some of the trade-offs like foreign exchange fees or additional taxes on dividends, I think it's a great opportunity to get involved or get into this stock at a severely discounted price versus where it was trading at the beginning of the year, despite their business fundamentally actually improving. The fact that the stock has gone down over the last 5 years by 1% after this recent dip, which is primarily driven by just broader interest rates going up, which is dropping the stock price, in my opinion, is crazy to me, noting that their revenues doubled, their EPS has doubled, their dividends doubled. I'd say their growth outlook is still really strong with the recent moves that they've made and the proven organic growth story they also have. Yet the stock is down, which means the valuation's essentially been cut in half versus where we were 5 years ago. So I think it's a great opportunity for my portfolio personally to get into this one at these prices here. Fundamentally, business is doing great. Stock price is telling another story. Lots of different vectors of growth, getting nice dividends in the meantime to wait. And at the end of the day, this company is spitting out free cash flow of $70 to $80 million a year, and they're trading at a valuation of under $1 billion. It's a pretty defensive company. I think even in a recession, they may get hit a bit, but these are products that I think will kind of stand the test of time over the medium term. So that's why I'm buying this stock. If you like this kind of content, be sure to give this video a big thumbs up. Would also love to hear your thoughts on Jamieson in the comments. If you are familiar with the company, if you've invested in the company, if you're a user of the product, would love to engage with you guys on this one as well. So thank you guys for watching. If you haven't yet, be sure to subscribe to the channel. Once again, please do give this video a thumbs up. It does help a lot with the YouTube algorithm, and I'll see you guys in the next one.